Please stay tuned after the conclusion of the podcast for additional important information. Hey everybody, welcome to another episode of Accrued Interest, PIMCO's podcast dedicated to serving financial advisors and the wealth management community. As always, I'm your host, Greg Hall. I lead the wealth management business for PIMCO here in the United States. And back by popular demand is Lotfi Karoui. Welcome, Lotfi. Nice to have you again.
Good to be back. Thanks for having me.
Frequent listeners of the podcast, as I hope you all are, will remember that we had Lotfi on the pod back on March 17th, about 6 weeks into your tenure here at PIMCO, trial by fire. And now you've been here about 6 months, so you're a veteran. I'm sure that you're not even remotely intimidated at the prospect of going through another podcast. Let me mention this up front so I don't forget it later on, but in addition to doing fantastic work within the four walls of PIMCO and spending a lot of time out on the road with our clients, which I have to say, you've been phenomenal in your commitment to our clients over the last few months, and we really appreciate it. I know they do too. But Lotfi has a weekly piece called The Credit Market Lens, which is published on the PIMCO website as well as through LinkedIn. You can subscribe to it if you want to navigate there during or after the pod and take a look at some of Lotfi's writing. It's really, in my biased opinion, quite excellent, and we'll add some context and some flavor to some of the themes we'll talk about today. So today we're going to be talking about credit markets. We're going to be talking about broader markets, and maybe we'll pick up sort of where we left off. When we last talked in early mid-March, we were, I wouldn't say at the very outset of the stress in the direct lending universe, but we hadn't yet seen the gates go up and sort of the investor behavior follow through on some of the early warning signs and the news stories of late 2025. So before we get into more detailed topics, let's just talk about the overall picture for credit markets, what you like, what we ought to be focused on.
Sure. I mean, look, as you may remember, back then there was kind of like two competing views. One was the view that this was a little bit reminiscent of what we went through in the run-up to the global financial crisis, i.e. there was genuine concern that this stress in direct lending portfolios would gradually morph into something bigger and threaten financial stability. And then there was a view, which we actually took back then, that this was merely a cyclical issue. Call it like a textbook example of how a credit cycle kind of unfolds a little bit. Direct lending as an asset class grew too quickly, by several folds over a 10-year period. And every time you grow an asset class that fast, you're prone to imbalances and you start seeing some deterioration in underwriting standards and stress, et cetera. Obviously, the heavy concentration in software doesn't, help, and it kind of complicates the picture from a fundamental standpoint. Now, here we are 3 months later. I think the systemic debate has been more or less settled. I think there's a better understanding that you can always describe a state of the world in which this becomes a threat to financial stability, but it's a little bit of a stretch. And I think the fundamental problems that are, that direct lending as an asset class has to grapple with are also better understood today. Mm-hmm. But if I kind of have to take a little bit of a mark to market of where we are today, you're seeing continued outflows in semi-liquid vehicles. Automatically, that means financing conditions are actually tightening, at least on the margin. Still a lot of question marks with respect to software. And I would say, we have a clear, clean sort of price discovery process in the broadly syndicated loan market. And I would kind of use that as a proxy a little bit. But if you look at the performance of software loans on the public side, big decline in prices first quarter, no recovery since, and somewhat surprisingly, still very low dispersion. Usually when you have, a sector that gets sort of derated that way, the analyst community does the work a little bit, and then we start picking winners and losers. That hasn't happened, I think, in software today. And I personally find that quite interesting because that tells you that, even if you're a seasoned sort of analyst, you're still having a tough time answering the basic question with respect to these businesses, which is, what is the terminal value given the threat that AI actually poses.
Right. And not differentiating amongst the different pieces of the software puzzle. I think the the outflows, I think our listeners will know this, being alert people that watch the news, but the outflows in the wealth vehicles in particular have continued to run by and large, 15% redemptions or plus or minus 11, 12, 15, 16, 17. Most of the participants have chosen to prorate those redemptions and to hold them at their 5, 6, or 7% levels at this point. And so you're sort of seeing this slow, maybe isn't quite the right word, but certainly a managed, measured bleed out of this space. Are you seeing, you mentioned that that's tightened financial conditions. Are you seeing the pace of deployment in the direct lending or the private credit space react to that, or has the institutional market stepped in and maybe offset it?
Unfortunately, the data is usually backward looking, so I would sort of caution against over-interpreting, the year-to-date flow or fundraising activity data that we have. But if you take it at face value, it shouldn't come as a surprise that, this is a mediocre year, at least by the standards of the last, 4 to 5 years. And so there's definitely been a slowdown, but it's not a collapse on the institutional side.
Right. And hence your point about this not necessarily posing a systemic risk. Have we learned anything in the last few months about the underlying credit quality of these portfolios, or do you still see investors reacting primarily to software fears, if not realized yet, and maybe sometimes when some investors are frightened, other investors become frightened and the crowd takes over?
Yeah, I mean, look, we generally rely on BDC holdings as sort of a proxy for how the broader direct lending market would look like. Sequentially, if you look at first quarter data, I would say on a quarter-on-quarter basis, things have been roughly stable. On a year-over-year basis, there's still sort of material deterioration. And so this feels to me like a slow motion thing, so far. Now, obviously, the bigger question mark is really with respect to the marks. And those are kind of, those are not only stale, at least that's the general perception among most investors, but they're also dispersed. And let me maybe take like 30 seconds to explain what I mean there is that, if you look at loans that are held by 2 or 3 more BDCs and you kind of calculate the price differential between the most optimistic manager and the most pessimistic one, on average, that's well over 6, sometimes 7 points, right? And so if you're an investor and you see that, obviously you ask questions about where the marks are, but the fact that they're so dispersed and the fact that there's so much disagreement across managers is probably a driver of that sort of cycle of redemption requests exceeding, the caps. But that hasn't been resolved. And that kind of surprised me a little bit because I would have thought that by now we would see more convergence in the marks. Doesn't matter what the level is, but I think there should have been more agreement across managers with respect to the marks, and we're clearly not there yet.
Yeah, and part of that is in these vehicles, the forcing mechanism just works a lot more slowly.
Totally. I mean, on the public side, prices are the intersection of supply and demand.
Right.
You can take any ICE and go on Bloomberg, or you can pull your favorite sort of pricing engine, and you get to see a price.
Right.
By the way, I remember back in the days before Trace was introduced in the corporate bond market, it wasn't uncommon to see disagreement between index providers. I mean, you could take the same bond and it would be priced a little differently.
Sure.
But that difference was like a point and a half, not 7 points, right? And so, but I agree. I think part of the problem is you have a benchmark, and that's really a very healthy public credit market from a microstructure or liquidity standpoint, and that benchmark, sets the bar a little too high, I think, for direct lending.
Yeah, well, it's interesting because, and you've written on this too. There's an interesting debate or divide happening even amongst the dedicated private lenders out there. Hey, is the solution to this malaise that we're feeling right now introducing more transparency into marks, or potentially more liquidity into the loans themselves?
Yeah.
And you've got strong feelings on this. Maybe we talk about it
Yeah, I mean, look, any steps that are taken to improve transparency are obviously welcome. You know, the less disagreement we can have among managers, the better the outcome for investors. There's absolutely no question about that. Now, there's a variety of ways you can achieve that. And there's certainly been, you know, a lot of ideas floating around. One of them was to provide daily pricing. And I think you're referring to a piece that I think, wrote
Back
a
in
couple
May,
of weeks ago,
yeah,
in May, where we said daily pricing is not daily liquidity.
Yep.
And those are two different things. I mean,
Yep.
I can price anything intraday if you want. You know,
Yep.
you can give me a model, I can put an input in it, and then we can get a
it's
price.
effectively what we're doing now.
Which
we
is
take a model
sort of what we're doing now.
When I say we, I mean the industry. Is we're the direct lending and private credit industry, broadly speaking, is taking a model, interpreting a price.
Yeah.
It's just not a price that's being transacted on directly or being set by transactions.
Yeah, and so to get like real liquidity, you basically need two-way flows, and there's lots of obstacles, I think, you know, that would prevent that from happening overnight. And in my view, the most obvious one is constraints on ownership transferability. I mean, these are sort of privately negotiated agreements. If you're a new investor and you don't have a pre-existing relationship with the borrower, it's actually hard to settle.
Yeah.
Settlement is another, you know, constraint. Quality of the documentation, you know, on the public side, every security has an ISIN. It's well documented. You kind of need to create that plumbing. And then I think, you know, bigger picture, I would say, I'm not sure incentives are aligned actually to move to sort of a liquid direct lending market, because the whole point about buying a direct loan, and more generally any private asset, it could be a private equity or private, you know, real estate, is that you're harvesting some illiquidity premium. That's sort of the trade-off. You're committing capital for a certain number of years, and you're trying to say, am I being compensated for that illiquidity premium? If I take away that illiquidity premium from you, well, then what is the point of actually deploying capital in direct lending to begin with? And so to me, the flaw is not in the illiquidity of the asset class. I mean, that's sort of a, you know, that's an attribute. The flaw is that compensation for illiquidity has gotten way too thin, and it needs to reset to more attractive levels. And we sort of need time, I think, to achieve that.
Yeah, no, those are really, really important points. I'd say probably the other barrier to adoption, and this is where I think the debate gets really interesting, because on the one hand, you've had some really prominent, dedicated private lenders attempt to build trading platforms for the underlying loans or to promote this transparency and liquidity. And like you said, I think generally we as market practitioners, we view that as laudable.
A positive thing, yeah.
On the other hand, a lot of people, I think a lot of advisors listening to the podcast right now would probably, you know, admit it to themselves and to us that, you know, the allure of some of these products has been that they don't get marked that frequently. And so the journey for the client, assuming you're going to a good place, which I think everybody has believed has been the case until very recently, you know, is smoother and it's easier to be on. And so if you introduce volatility, then the value proposition of owning private versus public
looks
securities,
very different. Yeah.
Right. It loses a lot of its appeal.
Totally.
And so there's, it'll be interesting to see how that, you know, resolves itself over time. I think my view for the wealth market is that, you know, there hasn't really been a time in you know, our lives, investing history, where the typical two-legged taxable U.S. investor has been desperate to own a lot of floating rate credit in highly levered companies, other than immediately following the financial crisis, when, to your point, spreads were really wide and there was a lot of excess profit to be reaped. And then this volatility aspect of the investment, of the asset class, has been really appealing. But that's eroded with the headlines and the gates going up. So for me, it all sort of speaks to not a collapse of the asset class, but probably a long-term normalization to a much smaller level over time.
100% agree. And I think the other normalization that will happen is that we'll probably go back to a structure of direct lending that looks a little bit like direct lending 1.0, more focused on the middle market.
Yeah, it could be. And also maybe we see a reevaluation of the asset liability mismatch and appropriateness for which vehicles actually holds some of this, right?
Yeah.
Lotfi, while we're on the topic of private lending generally, one of the things I've noticed is, especially with some of these bigger transactions going on in the marketplace right now, there seems to be a little bit of a proliferation of credit types. We see true private types of bespoke financings. We see stuff that's regular way in the listed market or arranged by banks. And there's a few things that, we've been involved in them too that seem to occupy maybe a hybrid zone in the 144A market. Or actually, I'm going to ask you to maybe explain some of these different types, but there's a lot of letters and numbers involved. And so I thought maybe for advisors listening, you could just sort of walk through the different ways that people are raising debt financing right now.
Yeah. I mean, like the argument that you hear more and more frequently is along the lines of like private credit is already more liquid than commonly assumed, and that that argument typically points to the 144A market as evidence of that liquidity.
Right.
Now, the idea that 144A securities are privately placed yet often trade with liquidity comparable to corporate bond markets. But I think that comparison is actually somewhat misleading, and it essentially conflates two very different types of instrument. So let's start with a 144A bond. I mean, that's technically sold through a private placement exemption, which essentially means that the issuer can sell the bond directly to qualified institutional investors without going through the full SEC registration process that is typically required for a public offering. But that exemption actually affects how the bond is initially sold, not how it's structured or owned or traded. In almost, in a very practical sense, I would say 144A securities behave pretty much like public bonds. They're syndicated. They carry a CUSIP or an ISIN. And so documentation is actually fairly standardized. They are rated the vast majority of the time. And then I would say perhaps more importantly, they're reported on trace. Whenever a secondary market transaction occurs, it is recorded almost real time. And it's traded by a very diverse investor base, including insurance companies, pension plans, and of course, asset managers. Mm-hmm. And so the price discovery process that is behind a 144A security is nearly identical to a public bond. There's actually virtually no difference. And in fact, if you look at the high yield bond market, the majority of the high yield bond market today is 144A securities. Now, why am I bringing that up? Because the liquidity of 144A bonds actually comes from their standardization, the fact that they are very widely distributed across a diverse, set of investors, not because they were issued under a private placement. And so this is fundamentally different from a corporate direct loan, a NAV loan, a CRE loan, or even like an asset-based finance type of structures. Those instruments are privately negotiated between a borrower and a small group of lenders, sometimes actually one lender.
Yeah.
And each deal has its own documentation, collateral structure, and that just means a higher bar for an ownership, transfer. Now, just to be very clear, none of this implies that illiquidity is a flaw. Illiquid assets actually play a very important role in a multi-asset diversified portfolio. But to me, the question is not whether an asset is illiquid or not, is whether you're being compensated for that illiquidity, right? And so that's, I think, the biggest question that investors, advisors alike need to ask themselves, which is, are you being sort of appropriately rewarded for essentially giving up on liquidity? And to be quite frank, I think assessing that trade-off, requires an apples-to-apples comparison. And if you conflate 144A bonds with genuinely private debt type of assets, you're essentially overstating that liquidity of private debt, and you're underestimating how much compensation you're getting against the liquidity.
I think it's a really tricky time for advisors trying to unpack everything going on in the private credit landscape because, of course, liquidity has risen to the fore because folks are redeeming from some of the dedicated products, and they're being told to wait for a period of time until the redemption prorations open up, and that can be frustrating for an advisor. And so you see a lot of rhetoric about the liquidity of the underlying loans and or marking portfolios on a daily basis, which can add transparency. And I think you and I have talked about this. We've talked about it in this session that we applaud moves for more transparency and more information for investors, but not everything is exactly the same.
Totally.
Yeah.
Absolutely.
Good. So let me return for a second to the systemic discussion around direct lending, because there were two things in our most recent secular outlook, which listeners of the pod will recognize as a piece that we publish once a year that tries to look out over 5 or 10 years, as opposed to our quarterly pieces that look out maybe over more of like a 6-month cyclical time frame. And there were two things I picked up in that report that I hadn't heard us say before, and I thought they were pretty interesting, and you're in a great position to offer some context. The first is I think we stated quite clearly, and Dan has come back to this topic a few times since, that we feel like the default cycle in credit has begun. Or I shouldn't say the default cycle, but a default cycle. Yeah. And the second thing we noted was that we are concerned, not running for the hills, about some elements of financial engineering that have begun to take hold in markets. So maybe we could talk about those two topics for a little bit.
Yeah, well, let me start with defaults. Look, I mean, typically defaults are a highly cyclical variable. I mean, the example that I always give, take a time series of 12-month trailing default rate in the high yield bond market going back 40 years. And what you see is 4 humps, basically. And those were the four last recessions. And so typically it does take an economic downturn to actually fuel a rise in financial distress in corporate credit. This time around, I look back at the last 6 months, we are seeing signs in some corners of leverage finance, most notably direct lending, and to a lesser extent, the broadly syndicated loan market, where I think, that default cycle is kind of starting to decouple a little bit, because the economy is still in great shape, at least in aggregate. I mean, there's some pockets of the economy that are doing better than others, but in aggregate,
like the
we're
data
still
moves around,
but this is still an economy that is growing. And so is there a risk actually that this time might feel a little different? I think that risk is high, yes. And I do think that, for direct lending and to a lesser extent the broadly syndicated loan markets, you have a few headwinds that I think will likely fuel a gradual increase in financial distress. But one is sort of an obvious point, but most of the liabilities are actually floating in nature. Well, policy rates are still high, so there's a little bit of a lagged effect from tighter monetary policy for quite some time. And so that 500 basis points of cumulative hikes that the Fed delivered between 22 and 23 is actually still putting pressure on those capital structures. Software doesn't help. That's a story that will take possibly years to get resolved. And by the way, there is a view out there that because refinancing needs are not that high in the near term, it should be okay. If you look at the vast majority of defaults in the United States, they tend to be strategic in nature. You don't wait until you have to refinance in order to restructure the balance sheet. You generally do it before, and you do it either out of court or in court. It doesn't really matter how you do it. But I think you have enough flexibility to do it before actually the time comes to refinance. And then I think, what we're discovering too is that, this is true for direct lending, because the asset class has grown so fast, at some point there's a limit to how much capital you can deploy. And so you start loosening your underwriting standards a little bit, and you start to write bigger checks and things like that. And so there's an element of, loosening underwriting standards, I think, that you definitely see in direct lending that you don't see in markets like the high yield bond market, for example. I mean, this will come as a surprise to many listeners, but the size of the high yield market has been roughly flat in the last 10 years.
Yeah.
I mean, to me, that's evidence that you're not misallocating capital. If anything, it's the opposite. It's a market that's been remarkably disciplined. You look at the sector composition, you see a lot of the old economy, energy, chemicals, asset heavy sort of type of companies. It's a little less than 40% secured. It's 55% double B rated. And so it's a much higher quality market relative to its own history. Most of the stress, I think, is and the excesses have built in some of the adjacent markets, and direct lending is one of them.
Yeah, no, I mean, it's an incredibly interesting point in this massive post-crisis expansion and credit or recovery in credit deployment. It hasn't been nearly as much a participant.
On the public side.
Yeah,
no.
on the high yield
if anything,
side.
it's been the opposite. On the return of financial engineers, look, we're late cycle. Obviously, you have really strong levels of yield support in fixed income, but if you look at the spread component, it's very thin. And it doesn't matter where you look. You can look at IG, high yield, United States, outside of the United States, like, the level of risk premium is very thin.
All the 90+ percentile.
Totally. Like you're at all-time tights or close to all-time tights. And so every time that happens, people start to get a little creative about ways to generate better returns using forms of financial engineering.
How do I make a thin spread look like a fat spread?
And so what's the typical ingredient? Leverage. Just look at the growth of levered ETF AUM, for example. That quadrupled over the last couple of years. The return of structures that have a little bit of leverage on leverage type of thing. Now, I just want to be clear, all these corners of the market are small in and of itself. They kind of look unrelated a little bit. So, unlike the run up to the global financial crisis where you had clear evidence that the housing market was caught in a bubble, and at the same time, investors started to grow mismatches between assets and liabilities. Leverage, rose way faster than today. I think this is not it.
Yeah.
But you're seeing signs of sort of typical late cycle behavior.
What are some of the structures that we're seeing? Again, I don't think you are forecasting doom. It's just, but there's stuff that on the margin.
The growth of levered ETFs is one example. These vehicles work great until they don't. They work great in a bull market, but once you unwind that, you have sort of a reverse effect. I think we've seen growth of fixed income CLOs that reference, illiquid underlying assets. Again, that works okay until you start having outflows and yield tested. And by the way, fixed, corporate bond ETFs have proven their resilience the last 15 years, but only because, the underlying liquidity of the corporate bond market has supported that. Unclear to me whether an ETF on a structured product can actually benefit from the same resilience, but that's something that will be tested. And certainly the AUM has grown a lot. It's still small when you put it in the context of the broader sort of credit market, but it's grown fast enough that I think it's something that will get tested at some point. There's an element of interconnectedness between financial institutions. There's a lot of sort of debt capital that is recycled in the same ecosystem. That structure, in my view, is still a lot better than what we had pre-GFC, but it's not perfect. And it will be tested at some point.
Right. You've got private equity sponsors that have lending arms that lend to their own deals. They may be constrained to a certain percentage, or somebody else sets the price, but you do have an interrelation between the two arms of the business.
Basically, institutions sitting on various levels of that financing supply chain end up lending to each other. And that increases sort of the interconnectedness, and it's something that will be tested.
And I think the other thing that we cited and Dan's mentioned a few times is also a little bit of a reliance on the rating agencies to preserve us from taking too much risk. But of course, there's limitations there too. They don't always get it right. You can try really hard to rate credits, but as the structures become more creative, it's harder and harder to keep up with the structures themselves, right? And that presents some issues as well. So we spoke about software. And we touched on AI briefly, but as we turn to kind of the view forward, of course, one of the major themes that's come to prominence, since the last time you and I spoke, or at least its prominence has been reinforced, has been just this AI CapEx supercycle. I'm curious how you're thinking about that these days. Are we talking more hype, more reality? How do you parse some of the huge numbers that are, coming out of the big research houses or the consultancies at this point?
Yeah, no, it's definitely reality. I mean, if you take consensus estimates at face value, we're expecting, a little over 1.6, maybe even more. And these numbers actually change on a daily basis almost. But let's take, 1.6 trillion of worth of CapEx just for 26 and 27. Right. And a big chunk of that will be funded in debt markets. And so that's really been the shift, is that, the AI CapEx cycle went from a cycle that was almost entirely relying on operating cash flows to a cycle that is now very much debt funded. And that changes the calculus completely, I think, for credit investors and fixed income investors more broadly. And so as it stands right now, I would say the re-leveraging impulse among the hyperscalers is certainly a reality. That is hard to ignore. I mean, a lot of these hyperscalers had negative net debt 3 years ago. Yeah. Now, they have positive net debt. And so there's definitely been more accumulation of debt on balance sheet.
Just so I understand, the major tech companies, the 7 or 8 biggest names, and shifting from funding all this massive investment from the cash flow of their businesses to debt.
And borrowing. That's partly because CapEx is now absorbing the entirety of your cash flow from operations.
Right.
And so it's depleting all of that. And so you have to sort of diversify your sources of funding.
Got to go find money elsewhere.
And the most natural way to do that is, debt capital markets, because equity capital is obviously more expensive. Yeah. And so that's been shift number one. I think shift number two that I kind of found actually interesting is the currency mix has also shifted, is that, usually most of these companies rely on the dollar market. We've seen them go into other jurisdictions, euro, sterling, Japanese yen, Swiss franc, Canadian dollar. And so it sort of opened up other markets, and it gave up, opportunities to investors in other jurisdictions to sort of get a bite at that apple a little bit. Are they
just managing curves and FX, or is there some deeper reason?
There's some of it. I think, the other reason is that you don't want to hit your concentration limits in dollar indices. And so you look for ways to, diversify the currency mix a little bit. And there's demand outside the U.S. too.
Yeah. I would imagine so.
Yeah. Now, really, the key for all this build out to end well is the pace and the timing of monetization. If you create a virtual circle where you're able to monetize all this CapEx at the same time that you continue to build, great.
Right.
If not, well, there's a risk that we kind of repeat the same mistakes that we made in the late 1990s, which is you go a little bit too fast, you overbuild, and eventually demand is unable to keep up with supply. But for now, I'm not seeing a lot of evidence that there's some overcapacity that we're building up in the system.
Right. Still, the metrics still appear a lot more disciplined than what we saw in late 90s,
I think that's a really excellent point that you're making, which is discipline has been way, way more present among investors this time around. Look no further than the equity market. Look at the performance of the Max 7 relative to the broader index. It hasn't been particularly stellar, over the last 2 years. Dispersed, winners and losers, but as a group, I think they've stopped sort of outperforming, the broader market the same way they had prior to the onset of the cycle. And then on the credit side, same thing is happening. Actually, some of the way the debt is being absorbed is also happening via wider spreads, particularly if you look at long-dated bonds, so 30-year versus 10-year bonds.
Right.
That extra premium that you have to pay to issue a 30-year bond, that's been rising for that group. And so that, to me, that's evidence that the market is actually paying attention. And it feels to me, having lived through that late 1990s period, it feels to me that there's more discipline this time around relative to the late 1990s.
Yeah, our CIO, Dan Iveson, who was with us a couple weeks ago, he does like to make the point, especially in talking about AI, that, as the bond guys, we don't capture the upside if it works, only the downside if it doesn't. And so you can imagine a world in which we and our brethren out in the markets, are a little bit more focused on protecting against risk out 10, 20, 30 years. On top of the AI CapEx cycle, of course, we had Greg Chernow on the pod talking about the commodity complex a couple of weeks ago, and we talked a lot about CapEx in global energy security and the reshoring of energy production and transportation, maybe the need to invest in different ways of getting oil around the world in the Straits of Hormuz. We also, we touched on but didn't go into, but he mentioned the impact of defense spending as countries around the world maybe come to the conclusion that the U.S. is not going to play the same role that it has in the last 50 years as the global protector, and so they need to rearm. And he mentioned that in the context of different materials and commodities that creates demand for. I guess my question for you is, if all these things happen at the same time, what do you think about aggregate demand for financing? And then where do we create this money from?
Yeah.
Where does this come from? Especially in a world where banks are still pulling back.
Totally. I mean, look, leaving aside the source of the financing, I think you got to go back to the basics, which is supply and demand. If everyone is spending at the same time, defense, energy, AI, well, that's a positive aggregate demand shock, essentially, and there's only a finite amount of savings in the system. And so how does the adjustment happen? It happens via probably higher real yields, and it means that yields are going to stay a little higher for a little longer here.
Right.
But that, to me, that's the most obvious way you address this. Now, remember, I talked earlier about the timing. There's the AI build out, and then there's AI adoption, right? If you get adoption to sort of come quicker than now, I have a lot of sympathy with the view that AI adoption is ultimately disinflationary, because the marginal cost of producing a digital good is very low. And so I tend to view the build out compounded with defense spending, energy, CapEx, et cetera, as a demand shock. I think the adoption is a supply shock. And kind of the intersection of those two things will determine where yields and ultimately, where the inflection, how the inflation outlook will look like. But the sooner you get adoption, I think the higher the odds that you set in motion a virtuous cycle, in my view, where adoption is it absorbs some of the inflationary impulse from the forces that you discussed. Right. So there's a lot of moving parts.
There's a lot of nuance in this conversation.
And sometimes you hear people overly focused on the demand aspect of this. Absolutely true. Look, you're spending more money. There's only a finite amount of capital in the system, and so the cost of capital has to adjust higher. That's the most obvious way you can clear supply and demand. But then you have adoption, and that, I think, frees up a lot of excess capacity in the system.
That's disinflationary and potentially has an offsetting pull. And then there's what goes on in the broader economy at the same time, right?
And it's also structural. It's sticky.
Yeah. You wrote a nice piece on emerging markets, which, to be honest, that's not, I think for the typical U.S. financial advisor, that's not a huge, allocation. It is something that we've had more and more people ask us about, especially as we've had our own views about finding value internationally. So maybe we can talk about that for a little bit, but also don't let me presuppose the answer. So you tell me where you're seeing some interesting value.
I think it's sort of worth starting with a broader context here, which is we're late cycle, right? And that doesn't mean the cycle is going to inflect tomorrow, but we are late cycle, And
what do you say is cycles don't die of old age?
Yeah, they don't really. I mean, and we're late cycle based on a bunch of metrics. You have an economy that's at full employment. You have valuation metrics that are at extreme level, and that's true in fixed income. It's true in the equity market. It's basically true in the broader sort of risk asset complex. And so the key, I think, ingredient to portfolio construction, in my view, is diversification, and sort of try to be ready for that inflection point. Now, the good news in fixed income is that you're still getting the best level of yield support you've had in 20 years. And that's really important, because it means that bonds have more convexity embedded in them. And it means that, the ability of the risk-free component to protect you in a bad state of the world is still, remarkably strong.
So pause on that for a second and make sure I understand what you mean by bonds have more convexity embedded in them.
So let's go to 2022.
Yeah.
Right. That's a great example. It was traumatizing for a lot of investors.
I was going to say, can we please not?
But I think it's a useful example, because back then, most sort of multi-asset portfolios were hit by a double whammy of high yields, so lower bond prices, and then lower risk assets, right? Why did that happen? It happened because the primary driver of high yields was a massive inflationary shock that led the Fed to tighten monetary policy very aggressively over a very short period of time. But the other reason is the starting level of yields was very low. I mean, policy rates were basically at zero. 10-year yields were less than 2%. Today, you've reset basically the level of bond yield premia at much higher levels. Take 10 years as an example, you're at 4.5%. If tomorrow you have a recession, basically the Fed is sitting on 300 basis points of cuts that they can deliver, right away. And so the whole curve is going to move downward, and you're going to get a nice sort of embedded stability from owning bonds. And I think that point, it's interesting. You said, I've been talking to a lot of clients, but I've been on the road the last, 2 months or so.
Yeah.
And it was striking to me to see that there's a lot of views that are still anchored on either some of the assumptions that prevailed in that 22 period, or even sometimes, the post-GFC, pre-COVID type of period.
You
this
couldn't
is different.
be more right. When we talk to advisors, there's still, I shouldn't say still, but I mean, they've got every reason to hold this, or they've got every right to hold this belief, but very, very distrustful of bonds playing that traditional role in their portfolio as the non-correlated diversifier. And based on the experience in 22, I think that's driven a lot of the interest
it's a
in
little
the
bit of
floating
muscle
rate credit
memory.
market, right? Yeah, exactly.
Yeah, no, I totally agree. Now, today, you can pick your capital market assumption for equities. How much, we're going to have for the next 5 years.
Right. Your return
7,
projection,
8%.
right?
Yeah. Even if you make super bullish, assumptions about that. The beauty of bonds is that, the starting level of yields pretty much determines your future return for the next 5 years. And so if you take the Bloomberg Ag as an example, the yield as we're recording this is around 4.75%.
Yeah.
That's going to be your return, for the next 5 years. But if you have an accident, then you get paid. Then that convexity in bonds kind of kick in. And so in general, I would advocate for a return to a more balanced multi-asset portfolio. Could be 60-40, whatever sort of that mix is. But I think it makes sense to tilt things a bit more towards bonds because of that, convexity in the event the economy sort of inflects and the cycle sort of dies. Along the same lines, of diversification is emerging markets. That was an asset class that was sort of unloved for, almost 15 years. I think now there's realization among a lot of investors that this is not your older brother sort of, EM market. There's more credibility from the central banks. A lot of the external vulnerabilities that have typically fueled crises in EMs are just not there. That doesn't mean that there are no issues. There are. A lot of countries still running inflation that is, a little too high. There's some, fiscal issues here and there. And so, again, like country selection is key. But by and large, I think there's definitely premium in EM. And I think the ability to give you diversification in a bad state of the world is also, a lot better. The final thing that I would add is that, and you mentioned 2022, which I agree was a very traumatizing experience for a lot of multi-asset investors. But here's another difference between today and 2022. Economies globally, even if you looked at, developed world, are much less synchronized today, right? Like back in 2022, if you looked at the cumulative change in 10-year yields, you could pick Japan, Germany, Australia, Canada, US, UK, everything co-moved together. Like everything moved in the same direction. That's not the case today. And in fact, it will probably come as a surprise to a lot of listeners, but 10-year yields in the U.S. have been kind of flat since January 2025. It doesn't feel that way. Because you have, a lot of vol and so every now and then some geopolitical shocks,
et cetera. It feels like
cetera.
we've been on a roller coaster, but we
that's
barely
where
moved.
you've been in the last 18 months. And so what happens in the meantime is that you're just accumulating income, right?
Yeah.
Meanwhile, you have other jurisdictions like Japan and Germany where yields are still drifting higher. And so your ability to sort of, generate alpha by just sort of moving from one jurisdiction to another is remarkably better today than it was back in 22 when everything was sort of correlated and moving in a very synchronized way.
It's interesting. We have been doing a lot of research on where the average advisor, average client portfolios are situated in the U.S. today, and 60/40. We're so far from 60/40 or anywhere near it. I mean, 90/10 is probably a better estimate.
And by the way, that was the right call.
Oh, absolutely.
90/10 was the right call with the benefit of hindsight. But this is why I said earlier, I think we shouldn't sort of anchor portfolio construction today to the same assumptions that prevailed the last 15 years.
And advisors out there, they've earned their way into 90/10, right? They've compounded their way there in the equity markets. I think one of the things that matters a lot in the U.S., and it's different around the world, but in the U.S., if you've got the privilege of being in that place of having generated such great returns from the equity markets over the last 5, 10, 15 years, you're sitting on a lot of low basis stock that's hard to sell if you want to rebalance. If you've taken advantage of some of the great innovations in tax loss harvesting, that problem is even more pronounced. And one of the things that we see in industry flows and our own data is that advisors are acting on the marginal dollar. Mm-hmm. So they're following your prescription on the marginal dollar. It's just going to take a while, I think, for us to get ourselves back into a more traditional
60/40,
state. Yeah, if we ever get to 60/40 again, but certainly we could move quite a lot. From where we are today back towards that. That
and the point shouldn't be about sort of bonds beating stocks or anything like that. It's just that you're getting better yield support. And in a state of the world where the cycle inflects, it doesn't matter what the shock is. It could be the end of the AI CapEx cycle. It could be something else. But, at some point, this cycle will end. You have an extra embedded stability in bonds that I think stocks don't give you.
Right. And you made the point earlier about, companies that are, coming up on a refinancing wall. And it's best to be prepared going in and avoid the cliff or the calamity when it comes, which I think we'd all subscribe to. So, not exactly breaking news here at PIMCO that we like the idea of adding bonds to the portfolio at this point, but I think we've been pretty humble out there about, the relatively unattractive state of bonds, going back 2021 where the world was pretty much at a zero bound, like you said. Compare that to today, and you're just in a very different neighborhood, right?
Yep.
All right. Well, Lotfi, as always, this is an absolute pleasure to have you on today. Thanks for joining us. Thanks again for all the good hard work you're doing, not just analytically, but spending a lot of real time out there with clients, helping them interpret and understand what's going on in markets. If you like what you heard today, or you're interested in going a little bit deeper on any of these topics, would really encourage you to hit the like button, subscribe to the podcast. Knowing you're out there helps us bring you more content and refine it to your tastes. If you would like to read any of Lotfi's research, if you'd want to go into any other topics that PIMCO's published on, visit us at PIMCO.com or the website in your home country. If you identify yourself as a financial advisor, you'll be taken to Advisor Forum. Advisor Forum is our one-stop destination for you to find what you need from PIMCO quickly, pragmatically, and then to move on with your day and making sure that you can deliver the best analysis and content to your clients. We'll be back with you in a couple of weeks with our next episode. Until then, hope you're having a great summer. Hope you enjoyed your 4th of July, and we'll see you soon.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures.